Look, it's A Trader with A Live Trading Show, market open to market close. A Trader is going to A Trader Cave to make professional profits while having fun all day. Come join him, and welcome to A Trader Show, a live trading experience.
Hey, it's A Trader. Talking about volatility, my brother is in theater, so he told me to try to stay in the middle of this camera, so you see me kind of peeking at it. Volatility, if you like profits and losing money gives you a little scare, you're going to want to know about volatility. When I talk about volatility, I'm talking about it in the definition of the stock market. Volatility is a tendency for prices to change unexpectedly. The change in response to new information and demands of impatient traders for liquidity. Impatient, a lot of times uninformed traders for liquidity. Volatility, risk, and profit are very closely related. Volatility concerns option traders because they measure and predict volatility to make profits. It concerns technical traders because volumes and volatility are correlated. And definitely concerns regulators because too much volatility indicates markets are not functioning well. There's two types, there's fundamental and transitory. Fundamental volatility. Values change when fundamental factors determine they change. Since dealers do not intentionally trade with informed traders, they make inferences about their fundamental from order flow. Fundamental is not common knowledge. So new information about fundamental values can change that fundamental value even without any trading happening. Fundamental volatility factors in commodities, it's a cash market, supply and demand conditions, interest rates, storage costs. In bonds, it's interest rates and credit quality. In stocks, it's quality of management, value of resources and technologies, demand conditions and interest rates. And in currencies, natural inflation rates, macroeconomic policies, and trading cap flows. Unexpected changes in any of these factors generate fundamental volatility in the instrument. Predictability. Expected changes in fundamental factors generally do not change prices. No surprise, no change. People base the expectations on existing information. Informative prices will incorporate in fundamental factors. Unpredictable price process is called a random walk. If you're a stat person, you know what they're talking about when they're talking about random walks. I get more into random walks throughout my other presentations, and you can check them out as you feel you need. They should be on YouTube. If they're not, they're on atraderlive.com. Fundamental price volatility in an informative price is unpredictable price changes. Fundamental uncertainties. Companies in technical research are volatile because value depends on outcome of research. There's high PE companies, price to earnings have volatile stocks. Instruments that are subject to political risk are volatile. For example, war. High leverage firms are volatile because ownership of assets is divided between bonds and equities. So fundamental uncertainties can cause this fundamental volatility. Let's talk about transitory volatility. When the demands of impatient, uninformed traders cause price to diverge from fundamental values. Eventually, they're going to revert to fundamental values. We can talk about the bid-ask bounce in this. It's when market traders buy at the ask and sell at the bid. Transitory spread component. Large order imbalance created by uninformed traders, value and arbitrators correct this. Transitory volatility and transaction costs are very closely related. High transitory volatility indicates that markets are illiquid. Measuring volatility in the components. Statistical models are pretty necessary to ID and estimate the two components of total volatility. To get total volatility, it's a sum of fundamental and transitory. We'll take a look at a Rolls serial in another presentation I have so we can measure the volatility within our market, within our equity, within our instrument. In conclusion, prices change. New information or uninformed traders cause volatility. You need to understand volatility because of the risk reward. Now remember, there's no fear, no greed, no hope. Don't let this complicate it too much. It's nice to get into the meat and potatoes of volatility. it really is nice to be able to calculate volatility as well. But to know everything about volatility is to watch the prices move, to learn why those prices are moving. We are in a world that seems so complex, but if you make it simple, you'll notice that the complexities are much easier to deal with when you realize that other humans who don't like to get as complex are the ones that are thinking about them and the ones that are making them happen. Same goes with volatility. Not a confusing thing to look at. Just really need to look at get inside and get those meat and potatoes once again. Come see me on A Trader Live, market open to market close, and I'm on Twitter, A Trader Live. I'm on Facebook. See my social sites. Love talking about different stocks. I'm not going to tell you what to trade in. I am always going to be able to tell you how to get those tools in your tool belt so you can start trading on your own. Have a great day.